Hello, I'm Liz Lumley of Finextra, and today I'm speaking to Mike Zehetmayr of IBM, and we're going to talk about risk data aggregation. Now, of course, everyone knows that banks need to comply with RDA, with the RDA regulation by January 2016. But outside of just making sure that they meet the compliance requirements, what benefits does RDA present for banks?
I think that if you look at the challenge that many banks have faced over the last 4 or 5 years, they've had a massive wave of regulation that they have to comply with. A lot of that is in reporting and transparency. Mm-hmm. I think that what we've seen is banks been operating on a silo basis, being able to say, I've got a particular regulation, I need to comply with it. The opportunity presented by RDA is that banks are now able to effectively, as one of our clients has described, make a lifestyle choice, which is not just comply with the regulation, but to recognise that there is material business benefit that can be achieved by being able to shorten the timing for reporting cycles, improve the accuracy of that data, and understand the lineage of that data. So, for example, I know of some banks which are spending multiple weeks. In one case, I know a bank has spent 60 days being able to do a number of their core capital reporting. In another instance, another bank takes 30 days to be able to do their CVA reporting. If you're able to bring that in, to bring that down to weekly, daily, intraday, the effect that has on the costs of being able to fund your business, the capital which you have to hold aside for the business, being able to plan to actual, not to plan to the planned outcome, will drive cost savings and efficiency savings within your organisation. Mm-hmm. It also means that your business will be able to respond to changing events within the market.
I like that metaphor you use, that it's not just complying with the regulation, it's sort of a lifestyle change for banks. So, how can banks really sort of sustain the benefits from RDA then?
So, if you take that analogy a bit further, which is if we look at the way that banks operate today, 2/3 of them recognise that they will probably be able to comply with the 1st of January 2016 deadline. That means a third won't. There's also another question, which is, this is only complying with 1st January 2016. To be able to then move to a basis where you have reporting which is on a daily cycle, intraday cycle, that is something which is a multi-year program. And what we're starting to see is many banks and institutions starting to recognise that the traditional cycle of annual planning, where they're investing in IT for the next year, that's not sufficient for being able to meet with RDA. So if you're going to bring the operational data around how your business is operating, together with your financial data and with your risk data, that is something that banks over the last 20 years have struggled with. Has been a perennial problem. There's a recognition now, if you can take that, and it will take multiple years to be able to move to that position where you can bring that data together, you understand the lineage of that data, you have the accuracy around that data, that will then drive benefit within your organisation. It will also allow managers within the business to have a clear understanding of how they should respond consciously to changes within the market. And that's not just a crisis within the market, but changes within the market around funding, around capital, around changes in the counterparties they operate with. And that will drive significant benefit for the banks.
So I wanted to keep on this theme of this being a lifestyle change for banks. I mean, of course, not just RDA, but all the regulations banks are dealing with now kind of were a response to the financial crisis of 2008. We're now in 2014, almost in 2015. What is the state of banks today? I know you mentioned change, not crisis, but how ready are banks to deal with the financial crisis of tomorrow then?
I think that the industry accepts that regulation is retrospective, in that it deals with the problem of the past. And I think that if you look at both 2007, 2008, and you look at the bond crisis in 1994, there's acceptance that in 2007, 2008, Basel II, what the banks had to do wasn't sufficient to be able to deal with that crisis. None of us have a crystal ball. But what we can do is plan for better understanding, a better way to be able to respond to future events. And I wouldn't take a crisis. Where we are coming from at IBM is to say, move to a position where you understand your exposures, you understand what's driving those exposures, you understand and trust the data in which you're making decisions upon. Have that data at a point where you need it to be able to make a decision, not something where, for example, Lehman's, it took 6 months for people to be able to unwind what their exposure was. You need to be able to understand that at the weekend when there was a failure, not 6 months after it. But I also go back to the point, which is this isn't about dealing with just crises, it's being able to respond with changes in the market. Our market is highly interdependent. There are changes happening with our market by the introduction of greater clearing, more central counterparties. That will change the dynamics in the market. We need to have, the banks need to have a greater insight in the data and understanding of that data and greater accuracy and timeliness of that data to be able to deal with the changes within that are happening in the market today.
I find it interesting that you mentioned Basel II. I used to cover Basel II a lot pre-crisis, and there was a lot of talk about increasing the amount of capital that banks held. And now, of course, those discussions are happening again today. Is that the right route to go down again, do you think? Or
I think capital's there to provide a buffer to protect against the unknown. With the change in RDA, what we're doing is ensuring that we're bringing together the operational data, the understanding of how the bank is operating, financial institutions operating, with the exposure, the risk that the organisation is running, with the finances, the book of record of what the bank's actual exposure is on its balance sheet. From my perspective, it's not a question of whether or not there's sufficient capital. It's actually, do I understand how my organisation is operating? Am I able to accurately demonstrate from an operational management perspective, I am managing that risk and that exposure effectively, and that is consistent with what I am reporting to the regulators and the wider market and my shareholders and my bondholders, that those two things line up. Because if they don't, and I think this is the risk for banks, that 1/3 of banks who don't believe they're going to be ready for the 1st of January 2016, is that there will be an impact on them because there will be less confidence or a lowering confidence in their ability to be able to manage changes within the market and to be able to respond if there is a crisis. And that will be reflected in the cost in which they'll be able to raise money within the market, and that may be intraday funding, overnight funding. It also may reflect in their issuance of debt as well.
Excellent. Mike, thank you very much.
My pleasure.